Ladies and gentlemen, today I'd like to talk about the buy and write on Fortescue metals and the covered combo on the same stock. So what is a buy and write? Well, a buy and write is when you buy the underlying stock and then you simultaneously sell an out of the money call option. And I think Fortescue at the moment looks appealing for that sort of trade. Now, just quickly, this came across my desk. It's a bit of current research from Macquarie Group, and they've done a report here just on the global iron ore miners. And the rub of it is here, they've all got virtually all of them down as an outperform, and that's pretty much because the current spot price for iron ore, as you can see by the chart, is around about $166 a ton. So, you know, they're digging it up for say $20, $30, $40, and they're selling it on market for $166. So they're making some pretty good margins there. Now, let's now have a good look at Fortescue for the buy and write. Now, here's the market depth of Fortescue that I took just moments ago. Last trade there was about $20.51, and you can see there's its daily chart. At the moment, Fortescue's trading below its 50 and its 100-day moving average. Now, the buy and write simply would mean this: you would go out and buy Fortescue at the market price, and then you would look at writing an out of the money call option. Now, in this case, I've got the market here for the July Fortescue $22.50 calls, and the market for that is 67 to 78. Now, this is what it all looks like when we put it together as a summary here. So let's just say we've bought 5,000 Fortescue shares, we've paid $20.50, and at the same time we've simultaneously sold 50 of the Fortescue July 21 $22.50 calls, for which you get paid 73 cents. Now, each options contract currently on the ASX equals 100 shares, so that's why it's 50 contracts of the options. 50 times 100 is 5,000, matches up precisely with the shares. Now, that's a 99-day time expiry, so between now and the day this option's due, which is the 15th of July, 99 days will need to pass. So here are the numbers. If the call options are in the money come the end of the expiry, that means Fortescue's greater than $22.50, the calls will be assigned. That means you will sell your stock for $22.50. If that happens, you would make roughly a 11% return within 99 days. You annualize that, it's around about 40%. Now, if anyone can do basic arithmetic, you can just prove those numbers yourself, but that's just how it works. On the flip, if Fortescue is not above $22.50 come the end of July, the option you have sold will expire worthless, and then based on your purchase price, we're using that as the base of, in this example here, of $20.50, you would make a standstill return of around about 2.3%, which, considering you're getting about 0.4% for a term deposit these days, it's still pretty good. Now, if you were to do the buy and write, they're the two outcomes. Either the stock trades above the strike price of the call gets exercised, you sell your stock and you make that capital gain. Or the stock's not above that price, therefore the option you've sold will expire worthless. You've got to remember, you've sold an option on Fortescue at $22.50 for someone who will take that up and buy it off you. But they're not going to buy it off you if they can go into the market and buy it for less. So then your option would expire worthless. So it's a very, very simple, easy strategy to put together. And I think Fortescue at the moment is just in a sweet spot because it's between their two of its big dividend payments. And whilst the iron ore price is staying as firm as it is, every day that goes by and the iron ore price is basically north of $160, that's going to be great for Fortescue. I've got some other slides, you know, from that Macquarie research. I'll just quickly put them up here, and it just goes to show what sort of potential gains Fortescue could be making in terms of their earnings if the spot market stays where it is. Now, obviously, that's where it is now. In time, it might not be, so that'll fluctuate. But the longer it stays around this level, they are just literally just swimming in dollars. Now, what's the covered combo? Well, it's just essentially the buy and write, but we also then sell an out of the money put option. So here is the current depth of the Fortescue July $18.50 put option, and that's worth 66 to 76 cents. Now, when you sell a put, you're essentially saying to the market, you're putting your hand up and saying, look, I'll buy off you, the market, more Fortescue at $18.50. It's currently $20.50 in the market, but you're saying you're happy to buy it at $18.50, so at a discount. But because you're putting your hand up to say, I'll buy it, you want to be compensated for that now. So the market pays you, in this case here, an option, it's worth probably say 71 cents as a midpoint. But it does create an obligation that if Fortescue is below $18.50 come expiry, you will be obligated to buy more of it. So it's important if you go sell a put, you've got the funds to back yourself. Because if you don't, then it can be turning what's an exciting and pretty good type of strategy into a bit of a nightmare. So let's now look at the covered combo on Fortescue. And here's the summary here. So same as before, we bought 5,000 Fortescue at $20.50. We sold 50 of the July 2021 $22.50 calls, for which we got paid 73 cents. We also sold at the same time 50 of the July 2021 $18.50 puts, for which we got paid 71. Now together, that's $1.44 straight away. These, when you sell options, they settle to what's called T+1. So if we trade today, they settle tomorrow. So there's $1.44 that gets credited to your account straight away. Because you've sold options, you will be creating margins on your account, but because you've bought the Fortescue stock, that will be used as the collateral to cover those margin obligations. Now, unlike the Buywrite, this has two potential outcomes. Either the price is above or below the strike price of the call. When you do a covered combo, you've got three options. If the stock price is above $22.50, the call will get assigned, meaning you'll sell your Fortescue at $22.50. If you bought it at $20.50, you're going to make $2 on that, plus you keep the premium, plus you keep the premium from the put you sold. Because if the stock's at $22.50, no one's going to put the stock to you to buy more at $18.50, right? So that put will expire worthless. Another outcome could be between the Fortescue at come expiry could be less than $22.50, but greater than $18.50. Now, if that's the case, both the call and the puts you have sold will both expire worthless. You've kept the premium, no one can take that back from you, and you still own your 5,000 Fortescue shares, which means you're free now to go repeat the same strategy again, or just wait it out and see what the dividends are. There's a variety of things you can do. And the third alternative is Fortescue's actually declined in price. It's now below $18.50. So that means because you've sold the put, you are now obligated to buy more of it. So you've already bought it at $20.50. You're now buying more of it now at $18.50. But you did get compensated the premiums for that as well. Going through the rinse and all that sort of stuff, that would give you an average purchase price if you were assigned on the put around about $19.10 on that basis there. But again, what's really good with this strategy is the potential returns. Again, because you're harvesting the premium out of the marketplace. So you've got to come to accept what are the risks in this. Well, it's the holding risk of Fortescue. Is it a stock you're happy to have in your portfolio? If you're cool with it, then you tick that box and you can look at writing options against it. If it's a stock you don't want to hold, then don't go and do the strategy. So that's very important. Don't get conned into thinking, oh, I must do it. But if it's a genuine stock you like, I happen to like it. They are generating great cash flows because the iron ore price is just booming at the moment. And as every day goes by where it stays above $160 plus, that's just, money raining down on them and BHP and Rio. But that's the general summary for both the buy and write and the covered combo. So if that's a strategy you'd like to put together, get in touch with your broker. Some of you who watch these videos will realize that I'm your broker, so you can get in touch with me. Now, these strategies can be also employed on other stocks as well. There's a whole bunch that are listed on the ASX that meet this requirement, like the banks and Coles, Woolworths and other bits and pieces. But I just think at the moment, the numbers for Fortescue look pretty good. Rio, in absolute dollar terms, costs a lot of money to actually go and buy the shares. I mean, Rio right at the moment has got a spot price of $112. BHP at the moment's got a spot price of $45. And of course, Fortescue right at the moment's got the spot price there around $20.50. So you get more bang for your buck buying into them. So that's why I think at the moment it's either great for a buy right, or if you can understand and prepared to possibly buy more of them, do the covered combo, and you can see there the returns they can pay off them are pretty good. I trust you've liked this video. I trust you found the video to be informative on the types of strategies people can do, using exchange traded options. Please feel free to hit the like button down there, subscribe if you can, and I appreciate you taking the time to watch this video. Have a great trading day and take it easy.